Welcome back. One of our big rail companies, Canadian Pacific Kansas City, beat first quarter earnings per share estimates and delivered solid revenue growth. However, the news that's getting a lot of attention, the company trimmed its 2025 earnings per share forecast, pointing directly to tariff and trade policy uncertainty. Our next guest is an analyst who covers the stock. He has an outperform rating on the stock, and we'll talk about that with him. He's Stephen Hansen, Managing Director at Raymond James. He joins us from Vancouver. Stephen, thanks a lot for joining us. So the CP Kansas City has joined the parade of companies, Canadian and U.S., who are pointing to tariff and trade uncertainty as a reason for them to moderate their earnings outlook. How should Canadian investors be thinking about this stock amid this trade and tariff war uncertainty?
Yeah, thanks for the time, Paul. Good to be with you. Look, we continue to like the story here, is the short of it. You're right that they have trimmed guidance off the top line, but they're still looking for double-digit growth for the year. So, it's come down from, high teens to the low teens effectively, but with still mid-single-digit traffic growth. And so this is a story that continues to deliver on most fronts, despite the rhetoric we're seeing on trade policy across the board. Again, traffic quarter to date is up quite nicely here, even in the second quarter, and they continue to deliver on the revenue synergies that stem from the merger just a couple of years back. So continue to like it here. Strong outlook for the company and the team.
How far along is the company in integrating Kansas City Southern?
Yeah, the early sort of low-hanging fruit have been plucked, I think, Paul. But from a revenue synergy standpoint, this is going to be a multi-year journey. So we're probably in the third inning, if you will. We still have a long way to go. Again, the integration in particular between Canada, the U.S., and most importantly, the reach down into Mexico is just starting. We're starting to see a lot of the what they call self-help projects that they put in place now. These are new services that were never previously offered, are just really starting to get up and running. And so, again, we still think we have a multi-year runway.
And how dramatically will the completion of the integration transform this company and its ability to drive sales and earnings growth?
Yeah, significantly is the short of it. And we're already seeing the evidence of that, Paul. If you look at, the traffic growth we're seeing today relative to some of the peers, they're outperforming. The earnings growth, similar. And if we think about longer term opportunities for growth, they had initially targeted just over $1 billion in incremental revenue opportunity in a number of different buckets. We're already seeing evidence to suggest that that estimate will be too low across multiple categories. And they're just discovering new service offerings that they can, once they get in and talk to customers and understand what they can deliver, customers are coming to them now. So we do think there's a long runway here.
And in your note on yesterday's results, you had a bullet point reading shareholder-friendly practices are back. I gather the company has now reduced its debt to target levels, and it is more able to do things like buy back shares, correct?
Yeah, exactly. This is one of the really exciting parts of the story as we start to get into these sort of middle innings, if you will, is they've got leverage back down to where they wanted after the merger. So again, they took on some debt to buy KC. But now that we're in a better place and that debt's been paid down, they can start returning capital to shareholders. And they've got a buyback in place now for roughly 4% of the stock for the year. They're going at that quite aggressively, I would note already, over $300 million to start in the first month. And then on top of that, they've raised the dividend just 20%. So this becomes a much more comprehensive total return story for investors on watching your show here. One we think they can compound over time.
I'm just reading your comments from your note on the reduction to guidance. You think the run up in the Canadian dollar is material to that guidance outlook, correct?
Yeah, that's right. It's interesting, as I described, I think the traffic outlook hasn't changed that much. We're still looking for mid-single digit traffic growth on the period. Some costs may be a little bit elevated given some of the uncertainty out here, but really the swing in the dollar here just in the last 3 months has been pretty meaningful, and they've got a lot of exposure to that. So that takes down about 2 points off that earnings growth I described earlier.
Okay, you have an outperform rating on the shares and a target price of 115. Is that Canadian dollars per share?
It is indeed, yes.
How do you get to your target?
Yeah, we look at next year's earnings. We apply a 21 times multiple on 26. Again, we think this is a multi-year compounding growth story, though, over time.
Stephen, thank you very much for joining us today and sharing your insights. Stephen Hansen is Managing Director at Raymond James and an analyst who covers Canadian Pacific Kansas City.